All right. Welcome, everyone. Welcome to this TradeStation webinar, and thank you for taking time out of your schedules to be here and learn a little bit about futures and futures options, which is a great topic for today. Let's go ahead and get started. I'm going to do a few introductions and go over some disclosures that are necessary for every webinar of this type. My name is Jesus Nava. I'm training and education for TradeStation Securities. It's always a pleasure for me to be here in these types of presentations, especially where we highlight products that are supported by the TradeStation platform, and also where we highlight certain features and functionality of our trading platforms. Um, today's title is Futures Options Explained, Insights from the CME. And for a lack of one presenter, we have two. We have two guest speakers today, Craig Bewick and Brandon Wendell. I'm going to get to them in just a moment. And as I said before, I work for the education department here at TradeStation, and our intention is to make sure that all our users are aware of all the products that you can trade and all the features that you can use when you trade. Keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation, and past historical performance and any example that we talk about today is only used as an example, and it doesn't guarantee any future results. I also want to point out that Craig and Brandon are independent from TradeStation, and their thought process and methodology is their own, and is not, a recommendation of TradeStation. All the links are here in the disclosure. If you have any questions or you want more details on these disclosures, go to www.tradestation.com/important-information. As I said at the very beginning, we have Craig Bewick. He works for the CME Group. He has over 20 years of experience trading options and futures options and educating people on these products. So he's going to provide us a lot of information or good information on those products in just a moment. In addition to Craig, we have Brandon, who's also going to show us how to apply some of those examples on TradeStation's technology. He also brings a lot of experience trading futures, trading options, either trader and trading mentor. And we're going to pass the microphone over to them in just a moment. So let me go ahead and stop my share and welcome Craig, welcome Brandon. I'm happy to see you guys. How are you guys doing?
Real good. Thanks, Jesus. Appreciate the introduction.
Well, I'm glad to have you, Craig. And Brandon, how you doing? Brandon cannot hear me. Can
Sorry,
you?
my mic's doing a weird thing here. Sorry.
Okay, great. All right, guys. I'm just going to mute my microphone, turn my camera off. The floor is all yours. So ready to present, Craig? The floor is all yours.
Awesome. And just to make sure, Jesus, I'm presenting a PowerPoint now. Is that right?
Yes, I'm seeing the PowerPoint right now. Correct.
Very good. All right. Well, thanks again. Like I said, I appreciate the introduction. And on behalf of CME, I'd like to thank TradeStation for the opportunity to talk about this. We've been great partners with TradeStation really for more than a couple decades, and this is exciting because while we've done a ton of stuff on futures, we haven't done as much with options with TradeStation. So it's exciting to me that we're going to get into options a little bit with this presentation and really kind of talk about some of the differences between options on futures and options on maybe like equities, where maybe some people are more familiar with. So I'm going to get into some details on that. But first, of course, I'd like to thank everyone that's tuned into the presentation. It's not lost on us that you're giving up some of the precious time that you have during the day to listen to what we have to say. So I did want to say, again, on behalf of CME, thank you for tuning in today. And with that, we'll get started. We have a disclaimer as well. I'm not going to read it. I'll leave it up for just a second here. And, I guess what I will mention in terms of the disclaimer is that, futures and options trading requires knowledge of the product, how they work, some of the nuances. And we're going to teach some of that. We're going to demonstrate some of that today. But I would also encourage everyone to check out our educational portal called CME Group Institute. There's education material out there that I would consider 101 level all the way up to kind of like graduate level work. So I don't think there's any such thing as knowing too much. And I think that's a great resource for anyone that's either trading futures and options or thinking about trading futures and options. So with that, let's get started. The first few bullets I have here are just some general facts about our options suite of products here at CME. And the first section here talks about the tremendous, almost gaudy growth really in a few of the asset classes in terms of options that we've seen this year. So if you look at it at our options volume, and this is isolating what I'll call individual traders or retail traders. I'll probably use the term retail because it rolls off the tongue a little easier than individual, but really active traders is what I'm getting at. And as you can see, in terms of active traders, our foreign FX options volume is up 83% on the year versus last year. Rates are up 77%. Metals are up 74%. Pretty big numbers in terms of volume growth, in terms of retail traders trading our options. And then when you look at the equity indexes, it looks like it's a little smaller at 27%, and the growth is, but when you consider that that's our largest asset class in terms of retail trading, that's also a pretty impressive number that it's up 27% on a year-over-year basis, at least through May. So I think we've enjoyed some tailwinds. I think that some of the options popularity among retail traders has been fairly well documented in the financial press with things like zero DTE. And I'm not a huge fan of that term, but it is what it is. They're options that expire on the day that they're traded. But I think it has raised the awareness of options generally. And I think through that, people have discovered options on futures and some of the characteristics and benefits that they can provide. And we're kind of, like I said, we're seeing it in our options growth that I've got in front of you. The second one I want to point out is in a lot of ways, an option is an option. So if you're used to trading options on equities, a lot of those same characteristics, a lot of that same math, the Greeks, things like that are the same whether you're trading an option on an equity or an option on a future. Now, there are some nuances, and we're going to go over some of that. But if you're familiar with the strategies, and we're going to get into that in a little bit more detail, so I'm not going to stay on that topic too long here. But it's one of the things that we talk about. Like if you know options math, then a lot of that's applicable to options on futures. Also, options on futures are margined using the same margining system or methodology called SPAN that we use for futures, which means that there's capital efficiencies in trading options on futures. For example, if we forget about options for a second and we look at futures, the micro S&P 500 future is a futures contract that's worth somewhere between $25,000 and $30,000 worth of S&P exposure. But in order to hold that overnight, the margin or the capital that you have to put up is about $1,200 to $1,300. So it's a very capital efficient way to deploy funds. And that same methodology is used in margining options like we do in futures. Now, you know, it's only fair to point out if you buy an option, you pay for that up front, just like you would in equity options. But if you're short options, that margining comes into play a little bit and you can realize some capital efficiencies on your money. And then finally, like futures, most of our options markets open at 5 p.m. Chicago time on Sunday evening, and they're open essentially 23 hours a day until Friday afternoon at 4 p.m. Chicago time. So you can trade options on futures almost around the clock the way you can futures. And we're going to get into at least a little bit on why we think that's important. So this first slide I have is very simple. I'm going to get rid of this screen here real quick. It's simply a screenshot from CME's front end that we call CME Direct. And what I've done there is I've highlighted just a random at the money S&P 500 option that had 8 days until it expired. It's at the time I did this, the at the money was 55 for the strike was 55.45. And I've got the call bid and the call offer highlighted there. And what I did was essentially plug this same option into an option calculator that we have available on our website. And the reason I wanted to show this is that you can see on the bottom, and again, this is theoretical pricing now, right? It's a theoretical options calculator, again, that we have available on the website. And you'll see a lot of the same things you would see in an equity option. You can see the volatility at about 9.6%. See the delta, right? It's a near the at the money. So you'd expect that delta is around 50. And in this case, it's 51 delta option. Then you've got gamma, vega, and theta. I'm going to move on to the next slide because it's largely the same. And I just wanted to point out just one element of option pricing, just to give another example of why we say an option is an option. So I took that same option, that the 55.45 No, I've lost it there. The 55-45 strike. So the 55-45 call, and I've plugged it into that same option calculator that I was using before. And in this case, I want to isolate the days to expiration. So what started as an option with 8 days to expiration, that's what we were looking at on the previous slide, started with a theta value, which is essentially the time value in an option of negative 1.946. Now, theta, if you're not familiar, is essentially the value of how much time is left in an option. So if you're long an option and you hold all else constant, because options are dynamic and they're multidimensional, but if you're long an option and the time passes, the value of that option is going to decrease, so you have a negative theta. Now, if you're short the option, it's the opposite is true. As time decreases, the value of that option also decreases, but since you short it, that would be a positive move in your P&L. So what I wanted to show was kind of just a hypothetical situation where we took the days to expiration, we changed it from 8 days to 4 days. So essentially we cut the time until that option expires in half. And I wanted to show kind of how theta works, because it's really the same way that theta would work in an equity option. So if we look at it, we started at negative 1.946. The ending theta, and again, this is hypothetical or theoretical pricing. The ending theta is 2.738 or negative 2.738. So if you take an average there, and none of this is an exact science when you're looking at these options calculators, but it's a pretty good estimate. So if you take the average theta of the starting and ending, you come up with about negative 2.348. Now, if you take that number and multiply it by 4, which is the number of the days that we sort of decrease the life of the option, you come up with a theoretical value of the option decline of negative 9.368. Now, if you look here, if you take the 31.86 was the theoretical value of the option with 8 days left, and you subtract that 9.368, you come up with something very close to what this options calculator is spitting out. Now, it's not exact, like I said, none of these things are precise down to that decimal, but it gives you a pretty good idea of the theoretical value as different elements of the option change. So I wanted to point that out again, because it's just, I could have used Vega and I could have changed volatility, or I could have used Delta and I could have changed the price of the option. In this case, I chose time, but I wanted to point it out to show, or to showcase, that the Greeks work largely in the same way in futures options as they do in equity options. Also, if you're familiar with options strategies, what I've done here is taken a year-to-date view of our options strategies. Again, this is isolated to retail traders. So of all of the spreads, essentially, or of all the options executions that were executed as spreads or strategies, this is the percent that we saw in our markets. So in most of the markets, the most popular type of strategy that was executed was a simple vertical spread, or a call or a put spread. So either buying a nearby call and selling a further out call in terms of strike, or vice versa, or doing the same thing with a put. So that was the most popular strategy we saw. If you move down to the third, and I'll get into generics in just a second, then we saw strangles, then a ratio spread, then an iron condor. So hopefully you're familiar with these, because they're largely the same types of option strategies that you might be used to, again, in the equity options world. Same thing here. We have all of these sort of standard types of option strategies. Now, the generic might look a little high to you, right? So why are there so many retail traders trading what we might call a generic spread, which is something that doesn't fit into these defined categories? Well, I think the reason for that is anything that's not very specific, like a butterfly. Let's say a standard butterfly is that you buy one wing, you sell two of the body, and you buy the sort of further out wing. Well, if any of those wings is not equidistant to the body, that falls into a generic spread. So any slight deviation in a strategy isn't going to get captured in the categories that we have in front of you. So it falls into generic. So it's not necessarily like the generic spread suggests that retail traders are trading, 10 or 25 legged, really complex spreads. They simply might be what we might call a broken butterfly or something like that, where the strikes aren't equidistant to one another. But my point, moreover, is just to show that, you know, in our markets, we're seeing the same types of strategies that you might be used to, again, if you're used to equity or equity options. Now, there are a couple fundamental differences between options on futures and options on equities that are important to know. One of them is what we call a tick in futures, and this is the same in futures as it is in options on futures. So if you're familiar with equity options trading, and let's say you're looking at like a spider call that I have in front of you, and maybe that spider call is being quoted at 3.77 at 3.79. Well, instinctively, if you're trading equity options, you know that that call is on 100 shares of Spider. Same thing if you're trading NVIDIA or if you're trading Apple, it's on 100 shares of the underlying instrument. So you know, kind of instinctively or intuitively, that 3.77 really represents $377 because it's just 3.77 times 100. It's very easy to sort of figure that out. But with options on futures, they tick the same way that our futures do. So instead of on 100 shares, that dollar value of the bid offer is determined by what we call the tick size. So just as an example, in the case of the micro E-mini S&P future contract, that's a contract, again, I mentioned this at the onset, that's essentially worth 5 times the current value of the S&P 500. So the micro E-mini S&P future is essentially worth 5 times, at the time I did this, 5 times 55.62. Now that means that a full index point in the S&P 500, so if the market moved from 55.62 to 55.63, that's a dollar value of $5, because again, it's a $5 multiplier on that. Similarly, if you look at the way an option is quoted in futures on options, you apply that same multiplier to the bid offer. So in the case of the micro E-mini S&P futures options, and I put this in front of you here. So at the time I did this, I captured a screenshot where it was being quoted 27.25 at 28.25. The dollar value of that, instead of being like an equity option where it's times 100, is times 5. So what that bid offer of 27.25, 28.25 represents is really $136.25 at $141.25. Now, again, it's just a nuance with futures that I'll concede that you have to get used to. But once you do, it becomes second nature, just like the $100 multiplier in equity options. But you do have to get used to it, and you do have to know what those tick values are. And those are easily findable on TradeStation's website or CME Group's website. And here's just an example of some of them. So we just looked at the micro E-mini S&P. The E-mini S&P, so what we might call the standard size, is 10 times the size of the micro. So instead of the tick value being $1.25 or $5 a full point, it's $12.50 or $50 for a full point. Similarly, a NASDAQ, like the multiplier on the NASDAQ would be, the increment would be $5. The multiplier is 2, but the tick increment on the mini NASDAQ would be $5. In crude oil, it would be $10 for 1 penny, and so on and so forth. And I'm not gonna dwell on this for any longer, because this is something that, like I said, is easily findable on CME Group's website or TradeStation's website. And like I said, it's just something that you kind of have to get used to. So what I've done here is actually dug deeper into an example of the most popular type of strategy that's traded at CME among retail traders, a vertical call spread. And maybe I'll go through this, and when I'm done with it, Brandon can show you how you might pull up a call spread on TradeStation's options front end. But what I did, and I did this back in April, I put this together. And again, this is all hypothetical, but I used prices that were live at the time that I did this. So at the time, the futures, and I'm looking at it now, the futures were 5,038. I think they've moved up about 10% since then, that's a lot since April 25th. I'm just kind of realizing that as I'm looking at it. But anyway, at the time I did this, futures were 5,000, we're trading at 50.38. So I put together this hypothetical trade where we were going to sell one call at 50.90, which is closer to the strike than the call that we're buying at 51.30. So essentially, you would say that we're selling this call spread because we're selling the call. They're both out of the money, but we're selling the call that's closer to the money than the call that we're buying. So what ends up happening in this case is we wind up collecting premium on this trade. So we wind up collecting 16.25 points, which again, if these were E-minis, that's 16.25 times 50. So we wind up collecting $812.50. So if all else equals and the future when this option strategy expires is less than 50.90, then we wind up keeping that $812.50. Now, if the future rallies above 51.30, which is the call that we bought, we're going to wind up losing the amount of money that we paid, 812, or essentially we'll wind up losing the distance between the strikes, which is 40 points, subtracted from the 1625 that we took in. So we wind up losing 2375. So essentially what somebody does is sort of speculating on if somebody were to put this position on in a speculative manner, they're speculating that the price of the future at expiration is going to be below the call that they're selling. And again, this is all else equal. And during the life of the option, a lot of different things can affect the value, like implied volatility, for example, because in this case, since we're a net seller of options, we'd also be what they call short implied volatility, because again, we're a net collector of premium. So what I've done here, and this is just a simple P&L graph, and I put it in here because again, it's going to look like any vertical call spread that you might put on, even if it was trading equity options. They look the same, right? So the blue line is your short call, right? So as the price is lower, you essentially keep, this is a P&L based on the price at expiration. So as the price is lower, that blue line is worth more. As the price goes up, you start losing money. On the orange line, I'm sorry, that's the one that, that's the option, the call that you sold. The orange line is the call that you bought. So you wind up putting money out up front, and the lower the price, you're losing that money. And then as the price goes up, that option gains in value. And that white line is simply adding the two. So again, up until you can see that up until 50.90, this strategy is making money, then it starts to decline. And then after 51.30, that decline stops because now you're long the call. And because and that's actually important. That's an important distinction between just being short the call or being short the spread, which protects you against a large upside move. So if this option or if the future went to infinity, you're protected against that move because you've bought that upside call. So what I've done on the next slide, and hopefully you can read this, but again, it's sort of a more detailed version of what I did with the theta earlier in the presentation. So again, at initiation, this spread was worth 1625, and you can see that up here on the top, 1625. And that's, again, that's the premium that you took in. So what I've done is I've changed a couple of elements just to show theoretically what would happen to this option or this option strategy as different things change. So the first thing I did was I simulated an exaggerated hypothetical move to volatility where I decreased implied volatility by 5%, which is a big move in volatility. And I'll certainly concede that. I did this for sake of example. But if in fact we had a big move down in implied volatility, you can see that both options sort of lose value. But because the option that you sold loses essentially more value, and again, this is all hypothetical and theoretical, than the option you bought, the overall value of this position goes down. So instead of you've collected 1625, if volatility were to decrease, this strategy would be worth 9.25, and essentially you could buy it back if you wanted, and if this happened, for those 7 points and make 7 points on this strategy just because volatility went down. And again, we left everything else the same. We left dates till they expired the same. We left the futures price the same. We simply decreased volatility. Now on the next example, what we did was we put volatility back to where it was. Oops. We put volatility back to where it was, and we decreased the number of days until expiration. And again, you can see the overall value of this strategy or of this position went down because all else equals, we are a seller of premium. Again, we're short options, time goes down, and now this strategy is only worth 10.25. So we could, in theory, collect those 6 points. And then finally, I moved down here. I moved the price down. I moved the days to expiration back, move volatility back to where it was when we started, and simply move the price down. And once again, because we were, again, in this case, because we were essentially short deltas, we were short the nearby option, long the further out option. Again, this position would in theory be profitable for us because the price went down. And now finally, the last thing I did was I dropped the price, but I increased the volatility. So this option in theory would react as the drop in price would cause it sort of to make money, again, because we're short this strategy. But the increase in volatility would work against this strategy because, again, we're short volatility. And then, so you see that net, it would still be profitable, but not by as much as when we just, isolated some of those moves. So again, the reason I wanted to show this one was to give an example of how a vertical call spread might work, but also to give just another example that volatility, delta, gamma, vega, theta, these all work similarly in futures options as they do in equity options. And I'm going to pause there now in case Brandon wants to show how you might construct one of these spreads using the TradeStation front end.
Basically, let me go ahead and share my screen. I apologize. I get it going right there. I'm logged into a simulated mode, which has a lot of the features that you have on the regular platform. This is the Futures Plus, not the normal TradeStation platform, as you can see. Right now, I'm looking at EW, which are the weeklies. Question came up about the volume of these. You can actually watch it and see what's going on. I believe, I'm not sure if I have the volume column. I do have the Greeks. So I have gamma, theta, vega, and the deltas for the puts, as well as deltas for the calls. I even have the call theoretical values between the bid and the ask. So I could see if it's fairly priced. For instance, I'm looking at, let's see, August. And by the way, it's relatively easy to use. There's a lot of tools involved with this. So Craig was showing a bear call spread, bear call spread. We're selling a call, buying a higher strike call. Let's say we want to do that on, the micros. Let me bring those in. So I'll just create a new tab here, CME. Actually, I already did this a little while ago, so it's set up. All I would do is just type in the first couple letters, MES, and right there, MES is the product that shows, and I can load it up. Right now, it's giving me the September and December contracts for the futures. That's the underlying security. These are the options available on them. So I have the Septembers, and again, I can change the columns to see whatever it is that I want. Let me fix this. You can see, I don't know if you noticed, but a second ago, the numbers were slightly covered. So all I did was right click and I could fit all the columns right to the content, and I could always widen them more. And you can save, it's very customizable. But if I was doing the bear call spread, for instance, right now, we're looking at the MES at about 56.50, right around there. So if I wanted to sell, I can simply create a custom order here. Now I won't be able to do everything I can do in the live version with this, but I can do many things, obviously. It's just practice. So let's say I want to sell the 56.70 and buy the 56.80s, do a 10 wide spread there. So you see it built the custom. I go to submit and I have two options. I can go ahead, actually three. One, I can create the order to send it. You notice it says strategy creation is not supported. Unfortunately, I have to leg in this case because I'm in simulated mode. In live, you just send it in. There's other tools available as well, but I can put it into a watch list or I can create MWatch. So I'll put it into a watch list right now. You see how it came above and shook a little bit. So I can close this out or keep it there. There are a lot of templates too. Notice if I decided, I want to do a condor or I want to do an iron condor. There's, I think, 4 pages of templates. You would simply click and it loads it up. Then you just choose the different options you want for those different legs. Buy, sell, sell, buy. So it's an condor if I'm using all puts or all calls. And if I change, put, call, and do a bull put spread, bear call spread, it can do the iron condor. So right here is my watch list, and the bottom one, I'll go ahead and enlarge this a bit. Now the plus minus doesn't do anything here because that is the inside bid and ask. Again, my watch list, I can go ahead and click to enter into those positions as well from the watch list. So right here, I can go strategy creation, or I can use, there's other tools involved, but I can see pretty much anything you want on that particular spread. I can change all the columns, and there's a huge list of whatever you want to look at regarding that position that you have or the watch that you have on. So right now, I've got that MES. There's a couple others I'm watching as well. NASDAQ versus, oh, that's just a spread on the NASDAQ as well. And I can monitor them as well as the open positions that I might be looking at. If I'm looking at the individual futures, well, there's Bitcoin futures. I can even see a little bit of market depth there as well to see what kind of positions are going. So yeah, for the OCO orders, in order to be able to place those, and by the way, I'm relatively new. I'll admit I don't know as much as Jesus knows about this particular product. He actually put together a bunch of videos, the getting started on the futures TradeStation Futures Plus platform that we're looking at. So there's a lot more. It's a very powerful platform. So I'm just scratching the surface right now. But the easiest way to place the positions would be either to use customs right here where I built my own, or if there's certain ones you want to place. And there's another tool, if I could find it now. Where's it? Options. Well, strategy creation right there. Again, the templates are ready to go for whatever type of position you're looking at. Auto spreader. Yeah. I'm trying to remember where that one is. If I have it up here. Again, I'm still learning a lot of the stuff. I do have trades open, and oh, there it is, under automation, of course. Yeah. So again, under automation, and there's a lot of automation in there, you can go ahead and feed in what you're looking for. So again, create, and I can look for different contracts if I'm doing an inter-market spread to be able to do those. Or again, if I want to go ahead and place certain types of option spreads, there was a specific one I was looking for. Again, I apologize, just slipped my mind. Maybe, MD Trader. For those of you who are used to the matrix in TradeStation, you'll find that here as well. So again, if I go to explore, I either have the auto spreader, which loads many of the popular spreads that are out there. For instance, if I go to L, let me see, there's crude oil for LO. Those are the crude oil options. And we have, looks like June 24, July 24, August, and September 24 for a spread. There's butterflies, all sorts of things I can load up. I'll do feeder cattle versus live cattle. Oh, sorry, chose the wrong contract there. It's expired. But again, I can easily go in and filter what it is that I'm looking for as far as different securities by simply going to either auto spreader or right here, CME, spread. Let me go to NASDAQ, NQ. Oh, NG came up first. I'll go to Nat Gas instead. Sorry. And because I chose spreads, if I want to do, say, a calendar spread on Nat Gas, I can go ahead and do that with just a couple of clicks of the buttons here. I went and changed my tab first. CME, chose spread, or you can do individual options or individual strategies. They have all these templates already built in for it. So I chose a security, and now I just choose what it is I want to trade. Well, I'll do the simple August. Actually, we're in the September for the front month now. So actually, no, I'm sorry. I take that back. Heating oil and crude rolled, but nat gas has not yet. So I'll do the August versus September. Select. And there, I don't know if you noticed, but there was also a button. I should have pointed it out when I went to change right there, auto roll. So when I chose the different securities, I can automatically make sure it rolls to the front months when I go ahead and choose this. So there we are, getting ready to set a trade using a matrix on this calendar spread. So if I decide I want to sell, forgot the quantity. That always helps. Just do one. And I'll move that out of the way. Confirm sell. Sell the August, buy the September. That would be a bear spread because I'm selling the front month and buying the back. And this is actually future spreads. But again, I can go ahead and do the same thing if I bring in with the options. And I kind of showed you the custom spread building there. So I'll turn it back over to Craig. And if you guys have more questions about the platform, I'll kind of stand by and maybe do some more demo in a little bit.
That's great. You know, I love the way that you pointed out the ease with which you can create those spreads, because that's actually really important. I know you couldn't create it actually in your sim mode, but in production, because CME has a mechanism by which if you were to create some call spread, whatever it might be, and submit it to the exchange, a message will go out to all of the market makers saying, hey, somebody's looking for a quote in this 5,500, 5,550 S&P spread, whatever it might be. And that'll trigger them to start quoting that. And most of the time, you're going to find a better market as the market makers quote that as a spread, as you would on legs. So that ability to create that custom strategy is really important. And likewise with the auto spreader, a lot of professional traders use that functionality. So I think those are two really, really valuable things to point out. So let me get back to my, okay. So we just went through the example of that call spread. The other thing I wanted to point out here was the importance of being able to trade overnight, because as we know, the financial world is not flat, right? It's not isolated to the US, right? What happens here impacts what happens in Asia, impacts what happens in Europe. What happens in Europe impacts what happens here. So just because the stock market closes at 4 o'clock in New York doesn't mean the market stops moving, and it doesn't mean your position and your P&L stops moving. So I think it's really important. It's one of the sort of tenets of futures and options on futures trading, is that you can trade virtually 24 hours a day. So what I've done here is basically I've ranked the top, I don't know how many days, I think 7 days in terms of overnight volume here at CME. So the highest volume we've ever seen during the and this is isolated to just E-mini S&P 500, micro E-mini S&P 500. So the highest volume that we've seen overnight, and I did this a while ago, maybe we've had I don't think that we've eclipsed any of these numbers, but was in 2016, and I think this is a good time to point this out. The highest volume we've ever seen overnight was 2016 during the presidential election. So if you remember back then, the polls were all suggesting that Hillary Clinton was going to win that election, and the early returns came in, and President Trump obviously started getting a lot of votes early. If you remember, the market actually tanked right away when it started to look like Donald Trump was going to win that election. The market actually really sold off, but by the morning or by mid-morning, it had rallied even more than it had sold off. Well, it was a huge move overnight. In fact, the S&P 500 moved 132 points, which was a $6,600 move just overnight on a one lot. So, there were a couple famous things that came out of that. Carl Icahn, I think, famously was quoted in the financial press after that, saying that he actually left an election party to go put on an S&P position. And I think he said he made, I don't know, $10 million or something like that. But he said in the press, it was kind of a nice advertisement for CME. But moreover, I wanted to underscore the importance of being able to get at your position overnight, right? Some of the other big moves happened during March of 2023, when we had that volatility induced by the Silicon Valley Bank failure. Obviously, in 2020, we had a couple big nights when people were starting to realize how severe COVID-19 might get. We didn't know early in 2020 what that might turn into. Brexit was another one. And so on and so forth. The Russian buildup on the Ukraine border. So these geopolitical things can really move the market. It doesn't have to happen during the US day. So again, I wanted to point this out. These are some of the big moves that we've seen overnight, but it can happen at any time. And with futures and options on futures, you can get at your position during those overnight hours. So this was the screen that Brandon was, I think, going to show, and I've got it up on. So this is a tool. One of the things with CME's options on futures is that we've added many expirations from what we had even 3, 5, and certainly 10 years ago. So in a lot of the different asset classes on which we list options, there's expirations on every day of the week now. And that's part of, I think, what's contributed to this increase in volume in what we call zero DTEs. Because as there's more expirations, there's simply more opportunity to trade an option on the last day that it trades. The flip side to having all these expirations is we have all these expirations, and it can get a little confusing as to what's out there, what's available, what's the underlying, and things like that. So we created this simple yet, I think, powerful tool where you can click into this. I'm going to go to August here. This is if you noticed, I chose the E-mini S&P 500, but that's customizable up here. Any of the asset classes, any of the products. So this is the E-mini S&P 500, and any calendar day on which there's a hyperlink here is a day that we have an options expiration. So if I go down to like this Friday, just for example, if you look over on the right, it's really a lot of the information that you need to know before you trade that option. So it tells you what's the name of the option, what's the expiration, what time does it expire, 4:00 p.m. Eastern time, how many days till it expires, when's it available, is it American or European? That's important, right? You want to know if this option can be exercised early or not. In this case, it's European, so on and so forth. What the tick size are, I talked about tick sizes before. And then like what are the hours? So all of this information can be captured here in one place. Also, you can click up here to the future and it tells you exactly what future that option is based on, so that if you hold an in the money call, let's say until August 9th, and it gets exercised, well, now you'll have a position in the future. Well, you want to know when that future expires. You might want to know, particularly if you're trading something like WTI crude oil, that's a deliverable future. You're going to want to know like how long you have until that future expires, because you're not going to want to take delivery on WTI crude oil. In this case, it tells you right here, this particular future has 65 days until it expires. So, I'm just going to show like a quarterly here just to underscore that point. 4 times a year, we actually have 2 S&P options that expire on the same day. We have the quarterly, and I'm going to click on that. That expires at 9:30 in the morning on that Friday. That's a quarterly option, and it's American. And the future expires at the same time. Now, if you were to trade the weekly option, not the quarterly, but the weekly option on that same day, or that expires on that same day, that option is based on a different future. It's European. It expires at 4. And the future has 156 days until it expires. So I don't say this to confuse people. I say this to encourage people, if you're looking at options on futures at CME, to check out this tool, because it has so much good information. It's very simple, but it tells you exactly when every option that we have listed expires and the associated future that it's based on. So you can go into crude and kind of see some of the same stuff. If I go back a couple months, we'll see more expiries in crude. So you can see 3 days a week, we have expiries in crude. Same thing, if I click into it, I'm going to get all the information on the future on which it's based. So it's a very, like I said, very simple, but what I think is a very powerful tool. And then the next thing I want to show, and I'm not going to go back to the PowerPoint, I'm going to stay here, is we have a tool called CVOL. And I think it's one of the most valuable volatility tools that I've seen. And what CVOL is a volatility-based index that's proprietary to CME Group. So we've developed these indices for most of our major asset classes. And what we've done is, instead of looking at volatility in terms of, for example, the at-the-money strike, or maybe the 25 delta strike, or looking at one particular strike to get a handle on what implied volatility is trading in a given product, what we've done with the CVOL indexes is taken the entire strike array and come up with one value. So we think it's a very representative way to look at implied volatility on all these different options. So when I clicked into this, I think I had copper up, and I wanted to show a couple of things. Actually, you know what? I'm going to show our foreign currencies first. So here's, I pulled up the Japanese yen foreign currency option, right? And it has a lot of different elements up here. So I'm looking at, I'm looking at 1 year's worth of data here. I'm going to click off of the underlying. So this is the CVOL index. So this is essentially a measure of the implied volatility in Japanese yen options. As you can see, it's gone up and down, but what I think is kind of interesting is if I add the euro. So now I'm going to add the euro for foreign currency option, and you can see the divergence in implied volatility between the euro foreign currency and the yen foreign currency options. You can see the yen is actually trading at a much more elevated level of implied volatility, even versus where it has traded versus the euro historically. So right now we've seen an uptick in Japanese yen. We see a little uptick in the euro, but lately kind of a decline in euro FX volatility, where we've seen an uptick in Japanese yen volatility. And this is very critical information to know if you're trading options. But I think it's also valuable to know if you're not trading options, because of the information that it's giving you about what the options market is saying about the price of futures, right? So the higher the implied volatility, the options market is pricing in a bigger move in the futures price. Again, all else equal. The other thing I wanted to show quickly, and I did stage this, I'm going to pull up copper. So here's same thing, except with copper options. And again, we're looking at 1 year's worth of implied volatility. You can see we saw a spike back in May. Well, we've got a couple other measures here too. I'm going to click off of CVol. I'm going to click off of underlying. I'm going to click into what we call convexity. So what convexity measures is how high the implied volatility in the out of the money options is relative to the at the money. So in other words, on the wings, as you get out further away from where the price is currently trading, is volatility higher or lower than what is trading at the money? And you can see back in June, we had this multi-year spike in convexity in copper. So that was essentially the options market positioning itself for a big move one way or the other. It's not saying up or down or anything like that. It's not saying there's going to be a big move, but it's saying that the options market is pricing in an outsized move in the price of copper. And again, I just think that's another data point. It's valuable information to know, certainly if you're trading copper options, but also if you're trading copper futures or even other futures that might be correlated to copper, to know that the options market is pricing in these moves. And then finally, like I'll show, for example, skew. So skew is a measure of how high the implied volatility or how high CVol is in the calls relative to the puts. So the higher this line, the higher the call implied volatility is relative to the puts. So, as implied volatility in the calls go up, it's the option market, again, pricing those calls higher relative to the puts. So again, there's a ton of information on our CVol, and you can click around on this. I'm not going to go through everything because, it would actually be, we could do a presentation on CVol by itself, but I wanted to introduce this because I think it's a very powerful tool to look at implied volatility and the associated elements or associated measures that you can use implied volatility for, like skew, like convexity. And it really gives you a lot of information about what the options market is saying. So with that, I'm just going to quickly, if I can get to the top of my screen here, I'm going to quickly introduce one other, and I'm not even going to really click into it for the sake of time, but we also have a suite of tools on the website called QuickStrike. And if you Google cmegroup.com/QuickStrike, and that's quick without a C, so QUIK strike, QuickStrike, I would estimate that if you go back 20 years, the amount of options analytics software available at QuickStrike is probably in the tens of thousands of dollars worth of options analytics software 20 years ago, maybe even 10 years ago. In other words, I think there's a lot of really good options analytics software on our website that's available for free, and you can find it by going to QuickStrike. And like I said, for the sake of time, I'm not going to click into some of these tools, but it's out there, and I would encourage everyone to check it out. So with that, I'm going to stop sharing my screen, and I'm going to turn it back to Brandon in case he has anything to add. And if not, I'm happy to answer some questions.
Yeah, I'll also be here to answer questions as well based on the platform. I think to answer a few of the questions, let me share my screen real quick. And we do have the survey that'll be coming up for you as well, but for the workshop they're in. But yeah, there's plenty of help on the platform itself. I actually clicked on a lot of different things here, but you can see that in the Options Education Center that Jesus was mentioning earlier, there is a section right here. We got the webinar going right now, obviously, so it'll get posted very soon. But on this particular page, you can actually see explore strategies, futures options, understanding pricing and trading. There's an article PDF as well as a video available that explains it. So let me see, I can go ahead and post the link for that if you're interested. I'll post it if you're not interested anyway. As far as the commissions and pricing, it's actually all visible right on TradeStation's platform. If you go to tradestation.com, you'll see futures options as a choice under trading products. And going there, diving down a little bit more, it has all that information right there. If I scroll down a little more, what's available to you, the different contracts. There's actually even a page with symbology on it. So there's a getting started with the different videos about the platforms. Oh, there we go, TradeStation commissions. So Jesus has got a link for you. But yeah, all that stuff is available. I did click on one. Where is it here? Yeah, there it is under market basics for futures. Again, you can see either do a search or you've got pretty much the list right here. So the ES, you got the Futures Plus symbol, the TradeStation symbol, the root for the option symbol. If they have weekly options available, somebody was asking about that earlier, yes or no. So you could trade them on shorter time frames. And that's all spelled out for you, as a matter of fact. And you can see CME has the bulk of all those as well for trading availability. In addition, if you click on this little support button, once you're in the Futures Plus, which is web-based, that'll also pop up a lot of different help topics. There's the help library, the symbology as well, FAQs, and starting guided videos, which again, teach you about the platform. So let's see, I think we answered most of those. So if anybody has any questions for Craig or myself, I'll go ahead and turn the floor over for that. Clicked on the wrong spot there, didn't I?
And everyone, please, I just launched a poll for this webinar for the content, and if the examples will clear. So take some time to answer the 6 questions of the poll. It would really appreciate us. We really appreciate your feedback, and it'll make our presentations a little bit more efficient. Do you guys see any more questions that in the chat, or is that pretty much it?
I'm not a tax professional, so make sure you consult with a tax professional, but typically the options are on futures are considered 1256 contracts the same way that futures themselves are. So I'm not, again, I can't give any specific advice to talk to somebody about it, but actually on the TradeStation website, they do answer that question in a little bit more depth, but it's individually. But the options on futures are typically considered the same as futures themselves when it comes to dealing with that kind of stuff. Let's see, any other questions? And I actually was switching from the simulated to the live version of it just to be able to show you a little bit more about the auto spreader, things like that, because they're not available, unfortunately, in the sim mode. But you can see if I wanted to create and test a position, I could simply leg in as well. And it's very, very simple to do that. Oh, I was going to say, as far as the TradeStation account, if you need to add Futures Plus, I believe you do have to contact the client center. You might be able to do it. I'm not sure if you can add it online in the client center if you have to contact them.
Yeah, please contact your account rep. I think you need a different futures account to trade options on futures. So usually the futures account that you trade or that you have with TradeStation allows you to trade futures directly from the TradeStation desktop. But if you're interested in trading options on futures, you have to be set up with this different account that is linked to the Futures Plus platform, the one that Brandon was showing just a moment ago.
I see a question on here about first of all, thank you for the compliment on the options stuff that's on our website. I wasn't exaggerating. I think that some of the options analytics that we have out there, particularly some of that CVOL stuff, is really valuable. And it's pretty slick software. And I didn't mention that you can also download, some of that stuff is downloadable if you want to kind of do your own analysis, Excel or whatever. Some of that data on the CVOL tool is also downloadable. But I also got a question about, do we do webinars? We do from time to time. A lot of our education can be found on that portal that I mentioned at the onset, which is cmegroup.com, and it's or CME Group Institute is what we call it. If you Google CME Group Institute, that's our educational portal. We do our own webinars from time to time, but we do more with groups like TradeStation, that has kind of the direct relationship with their own customers. And, again, I said thank you at the beginning. I'll say thank you to TradeStation again here at the end, because this is valuable to us. And we do appreciate, you extending us the platform to talk about this kind of stuff.
It's great to have you, Craig. I mean, your expertise on the subject is appreciated, and I'm sure that a lot of people here, you know, are benefiting from that information as well. So thank you for spending time with us as well. Yeah, and any questions on account opening, again, yeah, there's a lot of information on the website, but I would still, you know, get somebody on the phone from the account opening department or an account representative that can give you all the details on how to set up that account. All right, I think this is the end. Again, Craig, thank you so much for your time, and Brandon also, thank you for joining us here at TradeStation, all right?
Thank you. It's been my pleasure. And thanks again to everyone for logging on.
Excellent. So everyone that joined in today, thank you for your time. Thank you for your support of TradeStation, and I'll see you next time on a future TradeStation webinar. Goodbye, everyone.